Key concepts. Adjustments. Closing. Prepaid expenses. Accrued expenses. Consumable inventory adjustments. Income received in advance. Credit losses, bad debts. Settlement discount. Depreciation. Accumulated depreciation. Asset contra account. Carrying amount. Pre-adjustment trial balance. Post-adjustment trial balance. Post-closing trial balance. 6.1 Introduction. An entity usually does business on a permanent basis without any interruptions. Moreover, the owners and managers of an entity need regular information on its financial results and financial position. The life of an entity is therefore divided into equal periods, called financial periods. The financial period is usually 12 months. The profit or loss of an entity is determined in respect of a financial period. Thus far it has been assumed that all transactions recorded were in respect of a specific financial period. The closing off of accounts and the determination of profit were recorded under this assumption. This does not always happen. An entity's accounts, and eventually statements, sometimes have to be adjusted to correct the balances before the final accounts and financial statements can be prepared. For more accurate financial statements at the end of a financial period, additional entries, which do not originate from source documents, may be necessary. The 5 steps relating to adjustments are as follows. Step 1. Identify the accounts that must be adjusted. Step 2. Determine how the accounts would be affected and what the balances of these accounts should be. Step 3. Calculate the amounts involved in the adjustments. Step 4. Record the necessary adjustments in the general journal and post the entries to the ledgers. Step 5. Ensure that the new balances of the accounts are now correct. 6.2 Short-term adjustments. The profit or loss account, statement of profit or loss and other comprehensive income, is always for a specific financial period. All the income and expenses must be included for the full financial period, whether they were paid/received or not, for e.g., expenses for a next financial period that have already been paid or income for a next financial period that has already been received. For this purpose, short-term adjustments are sometimes necessary. Short-term adjustments have to do with the apportionment of income and expenditure to consecutive periods within a year. This is income that is received in one period but that was earned in an earlier period or will be earned in a later period. The same applies to expenses that are incurred in another period. 6.2.1 Prepaid expenses. A prepaid expense is an expense that has been paid in the current financial period of an entity, where all or part of the expense relates to a future financial period. For example, insurance expenses are usually payable in advance. Therefore, when the financial year of a business entity ends, a portion of the insurance expense could relate to the next financial period. An adjustment is consequently necessary to match only that portion of the expense that relates to the current financial period with the income for that period. On 2 January 20.1 XAXA dealers paid a new annual insurance premium of $2,400. Its financial year ends on 28 February 20.1. Using this information you can work out that the actual amount spent on insurance up to and including 28 February 20.1 was only $400, which is $2,400/12 equals $200 per month for 2 months, namely, January and February. The $2,000 that was paid in advance represents an asset at this point. The apportionment of the amount between asset and expenditure elements will be as follows. R400 is an expenditure item in respect of insurance for the current financial year. This amount must appear in the profit or loss account and the statement of profit or loss and other comprehensive income. The R2000 is a prepaid expense and therefore represents an amount that will be used in future. It must appear on the statement of financial position as at 28 February 20.1 and is therefore a short-term, current, asset. A short-term asset is only created for disclosure in the statement of financial position as at the end of the financial year. At the beginning of the next financial year, the asset account will again be closed off and the amount returned to the specific nominal account, in this case, insurance. Golden Rule. One entry or leg of the adjustment journal always affects a nominal account and thereby the trading account or the profit or loss account. The other entry or leg of the journal always affects a statement of financial position account, balance sheet account. Accounting entries. The debit balance in the expense account for insurance has to be reduced by R2000. To reduce an expense account, a credit entry has to be made. The balance of the insurance account will then reflect the actual expense, namely, R400, and this amount can be written off against the profit or loss account. The prepaid amount of R2000 is a temporary asset on the date of the statement of financial position. It is debited in the prepaid expense account and shown on the statement of financial position under current assets. Journal entries. XAXA Dealers Adjustment Entry, 28 February 20.1 GJ12. Adjustment reversal, prepaid expenses, on the first day of the next financial year. At the beginning of the next financial year, a totally new set of journals, as well as ledger accounts, will be created. Only the balance sheet accounts will have balances in the general ledger for the new year because all the nominal accounts will have been closed off to the profit or loss account at the end of the previous financial year. You will open a new insurance account for the new financial year. The temporary asset account, prepaid expenses will be credited, will be closed off to the new insurance account, CT accounts below. All the nominal accounts will be created from scratch for the new financial year. The insurance account will be debited because the amount for insurance is an expense paid for the new financial year. XAXA Dealers Reversal Transfer, 1 March 20.1 GJ1. Details. Fall. Debit. Credit. Accrued expenses. An accrued expense is an expense that relates to the current financial period but is still unpaid at the end of that period. On 28 February 20.1, the end of its financial year, XAXA Dealers' water and electricity account shows expenses of R2880. On closer examination, XAXA Dealers' accountant establishes that the February water and electricity account of R360 has not been taken into account. Using this information, the actual expenditure on water and electricity for the year can be determined, namely, R2880 plus R360 equals R3240. The apportionment of the item between actual expenditure and the amount owing, liability, will be as follows. R3240 was the actual expenditure, to be reflected in the profit or loss account and the statement of profit or loss and other comprehensive income, and R360 is still owed, to be reflected in the statement of financial position, and must be paid at a future date, current liability. Accounting entries. the debit balance on the water and electricity expense account has to be increased by R360. To increase an expense account, a debit entry has to be made. The balance on the water and electricity account will now reflect the actual expenditure, namely, R3240. This amount can be written off against the profit or loss account, and the statement of profit or loss and other comprehensive income. The outstanding amount of R360 is a liability on the date of the statement of financial position. It is credited in the accrued expense account and shown on the statement of financial position under current liabilities. Journal entries. XAXA Dealers Adjustment Entry, 28 February 20.1 GJ12. Details. Fall. Debit. Credit. R. Water and electricity. Accrued expenses. Adjustment of water and electricity. Accrued expenses will be disclosed as part of trade and other payables. The amount for accrued expenses will therefore be added to the balance of the trade payables control account at the end of the financial year. Adjustment reversal, accrued expenses, on the first day of the next financial year. At the beginning of the next financial year, a totally new set of journals, as well as ledger accounts, will be created. Only the balance sheet accounts will have balances in the general ledger for the new year because all the nominal accounts will have been closed off to the profit or loss account at the end of the previous financial year. You will open a new water and electricity account for the new financial year. The temporary liability account, accrued expenses, will be closed off to the new water and electricity account, see TAC counts below. All the nominal accounts will be created from scratch for the new financial year. The water and electricity account will be credited because the amount is applicable to the previous financial year and not the new financial year. The amount will therefore be subtracted from the expenses for water and electricity for the new financial year. XAXA Dealers Reversal Transfer, 1 March 20.1 GJ1. Consumable inventory on hand. Consumables are all the expenses with regard to inventory bought not for sale but for use in the process of earning an income, for example, stationery and packing material. There will be physical inventory left at the end of the financial year that can be counted. A closing amount can then be determined. On 28 February 20.1, the end of its financial year, XAXA Dealer's stationery account shows that stationery to the value of R500 was purchased during the year. At a physical count it is determined that stationery worth R150 is still on hand. Using this information, the actual expenditure on stationery can be calculated, namely, R500, R150 equals R350. The apportionment of the item between actual expenditure, profit or loss account and statement of profit or loss and other comprehensive income, and the asset element, statement of financial position, will be as follows. R350 represents expenditure on stationery while R150 represents the value of the stationery that will be used in the future. Accounting entries. The debit balance in the stationery expense account has to be reduced by R150. To reduce an expense account, a credit entry has to be made. The balance on the stationery account will now show the actual expenditure, namely, R350. This amount can now be written off against the profit or loss account. The stationery on hand, worth R150, is an asset on the date of the statement of financial position. it is debited in the consumable inventory on hand account and shown in the statement of financial position under current assets. Journal entries. Consumable inventory on hand, stationery will be disclosed as part of inventories. The amount of inventories will consist of trade inventory plus consumable inventories on hand. Adjustment reversal, consumable inventory on hand, stationery, on the first day of the next financial year. At the beginning of the next financial year, a totally new set of journals, as well as ledger accounts, will be created. Only the balance sheet accounts will have balances in the general ledger for the new year because all the nominal accounts will have been closed off to the profit or loss account at the end of the previous financial year. You will open a new expense account, stationery, for the new financial period and you will close the temporary asset account, credit the consumable inventory on hand, stationery, and enter the amount in the new stationery account, CT accounts below. All the nominal accounts will be created from scratch for the new financial year. The stationery account will be debited because the amount is applicable to the new financial year. XAXA Dealers Reversal Transfer, 1 March 20.1 GJ1. Details. Fall. Debit. Income received in advance. Income received in advance is income that has been received during the current financial period but relates to a future financial period. Only the portion relating to the current financial period must be recorded as income, and an adjustment is necessary for the portion received in advance. On 28 February 20.1, the end of its financial year, XAXA Dealers' rental income account shows that our 10,400 was received. XAXA Dealers rents out a part of its building for our 800 a month. On closer investigation, it is established that the rental for March 20.1 has already been received. Using this information, the actual income received in rental for the year can be determined, that is, our 10,400, our 800 equals our 9,600, equals our 800 x 12. The apportionment of the item between actual income and the liability, amount owing, component will be as follows. Our 9,600 is the actual income and our 800 is due to the lessee because it was paid in advance. Differently stated, the income has not yet been earned. Accounting entries. The credit balance in the rental income account has to be reduced by our 800. To reduce an income account, a debit entry has to be made. The balance on the rental income account will now show the actual income, namely, our 9,600. This amount can now be written off against the profit or loss account. The amount received in advance is a liability on the date of the statement of financial position. It is credited in the income received in advance account and shown in the statement of financial position under current liabilities. Journal entries. XAXA Dealers Adjustment Entry, 28 February 20.1 GJ12. Adjustment reversal, income received in advance, on the first day of the next financial year. At the beginning of the next financial year, a totally new set of journals, as well as ledger accounts, will be created. Only the balance sheet accounts will have balances in the general ledger for the new year because all the nominal accounts will have been closed off to the profit or loss account at the end of the previous financial year. You will open a new income account, rental income, for the new financial period, and you will close the temporary liability account, debit the income received in advance account, and enter the amount in the new rental income account, CT accounts below. All the nominal accounts will be created from scratch for the new financial year. The rental income account will be credited because the amount is applicable to the new financial year. XAXA Dealers Reversal Transfer, 1 March 20.1 GJ1. Accrued income. Accrued income is income that relates to the current financial period but that has not yet been received. On 28 February 20.1, the end of its financial year, XAXA Dealers' commission income account shows an income of R2,200. On closer examination, it is established that an amount of R200 earned in commission has not yet been received. Using this information, the actual income and commission can be determined, that is, R2,200 plus R200 equals R2,400. The apportionment of the item between actual earnings in commission and the associated asset, the commission that has not yet been received, will be as follows: R2,400, which has actually been earned, and R200, which is still to be received. Accounting entries. The credit balance in the commission income account has to be increased by R200. To increase an income account, another credit entry has to be made. The balance of the commission income account will now reflect the actual income, namely, R2,400. This amount can now be written off against the profit or loss account. The outstanding amount of R200 is a temporary asset on the day of the statement of financial position. It is debited in the accrued income account and shown on the statement of financial position under current assets. Journal entries. XAXA Dealers Adjustment Entry, 28 February 20.1 GJ12. Accrued income will be disclosed as part of trade and other receivables. The amount accrued income will therefore be added to the balance of the trade receivables control account at the end of the financial year. Adjustment reversal, accrued income, on the first day of the next financial year. At the beginning of the next financial year, a totally new set of journals, as well as ledger accounts, will be created. Only the balance sheet accounts will have balances in the general ledger for the new year because all the nominal accounts will have been closed off to the profit or loss account at the end of the previous financial year. You will open a new income account, commission income, for the new financial period, and you will close the temporary asset account, credit the accrued income account, and enter the amount in the new commission income account, CT accounts below. All the nominal accounts will be created from scratch for the new financial year. The commission income account will be debited because the amount is applicable to the previous financial year. The amount will be subtracted from the commission income for the new financial year. Credit losses, bad debts. When a credit transaction occurs, there is always a possibility that the debt might not be paid. Such a debt that is never paid is known as a credit loss or irrecoverable debt. The amount that will never be paid by the debtor will be written off to the account called credit losses, which will be written off as a loss to the profit or loss account, the statement of profit or loss and other comprehensive income, at the end of the financial period. The debtor will then owe the entity no more money. On 25 January 20.1 XAXA dealers received a notification that a debtor, Atego, is insolvent. On closer investigation it is established that the debtor still owes XAXA dealers R230. Using this information, an adjustment must be made in Atego's account. The outstanding amount of R230 must be removed from his account and shown as an expense or a loss. The assets will therefore decrease and an expense or loss component, namely, credit losses, will come into being. Accounting entries. The debit balance of R230 on Atego's account has to be written off since he is insolvent and cannot pay. To reduce an asset account, a credit entry has to be made. Atego's account in the trade receivables ledger will be credited and will now show no balance. The trade receivables control account in the general ledger must also be credited and the credit losses account debited. The debt that cannot be paid is an expense/loss and is written off against the profit or loss account at the end of the financial year. Journal entries. XAXA Dealers Adjustment Entry, 28 February 20.1 GJ12. Details. Fall. Debit. Credit. The new balance for the Trade Receivables Control account will be disclosed under the heading Trade and Other Receivables together with accrued income under the heading Current Assets. The writing off of credit losses is explained in detail in Study Unit 9. The above solution is done according to Method 2, as explained in Section 9.5.6. 6.2.7 Allowance for Settlement Discount Granted. Allowance for settlement discount granted is explained in detail in Section 9.3. 6.3 Long-term adjustments, depreciation. Depreciation is discussed in detail in Study Unit 11. Business entities buy tangible assets, property, plant and equipment, that are not for resale but are used in the operation of the businesses. As these assets are used, they decrease in value. This decline in value of a tangible asset is charged against the profits of a business and is spread, apportioned, over the expected useful life of the asset. The apportionment of the cost of an asset usually takes the form of depreciation entries. XAXA dealers bought machinery to the value of $80,000 during the year. On 28 February 20.1, the end of its financial year, an amount of $12,000 has to be written off as depreciation. Using this information, an adjustment can be made in the books. An expense, namely, depreciation of $12,000, is created. Instead of crediting the machinery account, a special account, namely, Accumulated Depreciation, Machinery account is credited. The account is known as a contra asset account. Accounting entries. Depreciation is an expense to the entity and the depreciation account will therefore be debited with $12,000. The expense will then be written off against the profit or loss account. The apportionment of the depreciation is credited in the contra asset account, namely, Accumulated Depreciation, Machinery. The accumulated depreciation is subtracted from the cost price of the machinery to determine the carrying amount of the machinery. The carrying amount is shown under non-current assets in the statement of financial position and is part of property, plant and equipment. Journal entries. XAXA Dealer's Adjustment Entry, 28 February 20.1 GJ12. Details. Fall. Debit. Credit. R. Preparation of the trial balance. A trial balance is a statement of all debits and credits in a double-entry account book, with any disagreement indicating an error. It is therefore important to be able to identify at what stage in the accounting process a trial balance is prepared. A trial balance is prepared as many times as required, but at least every month. At the end of the financial year, as many as 3 trial balances are prepared. 6.4.1 Pre-adjustment trial balance. This trial balance is compiled to test the correctness of entries after the posting from the subsidiary journals to the general ledger, the same as the usual monthly trial balance. Its purpose is to test whether the requirements of the double entry system have been met, because if the trial balance does not balance at this point, the statement of financial position will not balance either. 6.4.2 Post-adjustment trial balance. This trial balance is compiled after all the adjustment journal entries have been posted to the general ledger. 6.4.3 Post-closing trial balance. This trial balance is compiled after the closing transfer journal entries have been posted to the ledger. In this trial balance, all the nominal accounts are closed off and the profit or loss account and the drawings account are transferred to the capital account. All that remains in the trial balance at this point are the assets, liabilities, and equity accounts. These are the accounts that appear as items in the statement of financial position. 6.5 Revision exercise and solution. Please attempt 6.5 revision exercise 1 under the heading Content. Self-assessment and solution. Now that you have studied this study unit, can you list the accounts and the items that have to be adjusted? Record adjustments in respect of the following: short-term adjustments such as prepaid expenses, accrued expenses, consumable inventory on hand, income received in advance, accrued income to be adjusted, credit losses, bad debts, long-term adjustments such as depreciation. Calculate the amounts in question. Record the necessary entries in the books. Prepare a pre-adjustment trial balance, a post-adjustment trial balance, and a post-closing trial balance. Show the effect of adjustments in the statement of profit or loss and other comprehensive income and the statement of financial position.